It's been a whopping 6 years since Buffett has made an investment like what just got announced. One of the biggest criticisms in recent years about legendary investor Warren Buffett is that he has been sitting on the sidelines and not investing, while stocks have soared. There have even been people talking about Buffett being washed up. Buffett even admitted to himself in his most recent annual letter just last month that he, quote, failed investors by not finding any attractive investments in 2021. Buffett's pile of cash at his company Berkshire Hathaway reached a staggering nearly $150 billion because the greatest investor of all time simply couldn't find anything worth buying. But boy, do things change quickly. In a matter of weeks, Buffett put nearly $20 billion to work into 2 separate investments. In this video, we are going to discuss these 2 huge investments and see how they compare to Buffett's famous investing checklist. Make sure to stick around to the end of the video because Buffett's investing checklist is something that you can start applying to your own investing today. But first, make sure to give this video a like because a ton of work goes into these videos and it helps out the channel a ton. Now let's jump into the video. The first of Buffett's investments I want to talk about is his offer to buy Alleghany, ticker symbol Y. Yeah, that's really their ticker symbol, just the letter Y. Alleghany is the quintessential Buffett investment. The company has kept a very low profile over the years as it doesn't even host quarterly earnings calls and has very little Wall Street analyst coverage. Alleghany is in the insurance business. The company operates primarily in the property and casualty insurance industry. Property and casualty insurers, or P&C for short, are companies that provide insurance coverage on assets, such as houses, cars, and other things, as well as provide liability insurance for accidents, injuries, and damage to other people or their belongings. Alleghany's largest business segment, accounting for over 50% of its revenue, is what is referred to as reinsurance. Without getting into too much detail, reinsurance is essentially insurance policies that one insurance company can purchase from another insurance company. Put even more simply, reinsurance is insurance for insurance companies. In addition to insurance, Alleghany also owns some non-insurance companies, including a steel fabricator, a trailer manufacturer, and even a hotel management company. One way to think about Alleghany is kind of like a mini Berkshire Hathaway. Just like Berkshire, it has its core insurance operations, but it also owns a collection of different businesses and other investments. Alleghany's insurance operation would fit in with Berkshire's larger portfolio of insurance operations, which includes Geico for car insurance and General RE, a unit that insures against major catastrophes and unusual risks. Buffett offered $11.6 billion to purchase Alleghany, which would make this the first sizable acquisition for this company in 6 years. In fact, this deal would be in the top 5 largest acquisitions in Berkshire's history. And really quick, just a funny aside that is going to go down as a typical Warren Buffett move. The price that Berkshire was offering to buy the company works out to $848.02 a share. This number is odd as most deal prices don't get into fractions of a dollar. However, the reasoning behind the unique per share deal price is classic. Buffett's original offer was $850 per share. However, he reduced it nearly $2 per share to account for the $27 million in investment banking fees Alleghany paid Goldman Sachs. Investment bankers give advice on deals and they get paid a ton of money for that advice, which isn't always the best. Buffett does not like investment bankers and views them as, quote, high-price parasites. So he refused to cover the additional costs and instead it came out of the deal price. Classic Warren Buffett, and at even 91 years old, some things never change. Now on to the second big investment Buffett made recently. The second big investment Buffett made recently was in a company called Occidental Petroleum, ticker symbol OXY. Occidental Petroleum is an energy company. The company is in the business of oil and gas exploration and production. It operates through 3 segments. The oil and gas segment explores, develops, and produces oil and natural gas. The chemical segment manufactures and markets basic chemicals. And the midstream and marketing segment purchases, markets, processes, transports, and stores oil, natural gas, and power. Occidental Petroleum stock price has really struggled in recent years. In May of 2018, the stock price was trading north of $85 per share. Then the stock fell until it hit a low of around $10 per share in October 2020. However, since the start of this year, the stock has performed very well and is actually the best performing stock in the S&P 500 so far this year. Between the shares Buffett has acquired and the warrants Buffett owns, he could have a stake that equals nearly 24% in the company. For those of you who don't know, a warrant gives an investor the right, but not the obligation to purchase a stock at a certain price. So for example, as part of Buffett's $10 billion investment in the company back in 2019, he received warrants that gave him the option to purchase nearly 84 million shares in the company at $59.92 per share. So let's say the stock is trading at $100 per share when Buffett goes to exercise these warrants. That means that despite the stock's current price of $100 per share, Buffett can purchase the stock at just $59.92. You can see why this would be extremely valuable and advantageous for Buffett to do. In order to be a great investor, you always have to be learning and improving your knowledge. This goes for investors who are just getting started, all the way to investors who invest professionally as a career. I truly believe one of the best ways to learn about investing is to study great investors and to understand why they make the investments they do. So that's what I want to spend the rest of this video doing. We are going to see how these two investments stack up against two core pillars of Buffett's investment strategy: circle of competence and margin of safety. One asset class that I have been studying and improving my knowledge on is contemporary art. Through my research, I've learned that roughly 2/3 of billionaires allocate between 10 and 30% of their overall portfolio to art. Additionally, contemporary art has not only outpaced the S&P 500 total return by 164% over the past 26 years, but this asset class is planning to grow from $1.7 billion to a staggering $900 billion by 2026. And Masterworks.io, today's video sponsor, has solidified itself as the platform for investing in contemporary art. They let you access their exclusive investments from names like Monet, Banksy, and other iconic artists for just a fraction of what billionaires pay to purchase. And getting started with Masterworks is super easy. You just go to masterworks.art/investor center, create an account, and check out what they have and invest in their offerings. So make sure to click the link in the description to skip the waitlist and invest with Masterworks today. It also really helps the channel, so go check it out. Okay, now back to the video. One of the most important lessons we as investors can learn from Warren Buffett is the concept of circle of competence. This concept is honestly super simple but incredibly powerful. Imagine a circle. This circle represents businesses that you understand and can determine a value for based upon your knowledge and experience. Any company that falls within the circle is a company you can invest in at the right price. Anything that falls outside of your circle of competence is a business that you don't understand well enough to invest in. This is how you limit mistakes when investing. You only invest in companies and stocks that fall within your circle of competence. According to Buffett, there's only 2 rules when it comes to investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Buffett has frequently said that his biggest investment mistakes have been when he has gotten too close to the edge of his circle of competence. Now let's see how this concept applies to Buffett's investments in Alleghany and Occidental Petroleum. Alleghany operates in the insurance industry. In the press release announcing the deal, Buffett has said that he has been following and studying Alleghany for 60 years. Talk about in-depth and thorough investment research. Honestly, based on Buffett's experience with insurance companies, there probably isn't a single investor on the planet that understands insurance businesses better than Warren Buffett. He was investing in insurance businesses even before he ran Berkshire Hathaway. Buffett first bought shares of the auto insurance company that he now owns entirely, Geico, all the way back in 1951 when he was just a 20-year-old college student. He bought his first entire insurance company, National Indemnity, in 1970. Through Berkshire Hathaway, Buffett has owned insurance companies for over 50 years, and today Berkshire Hathaway is one of the largest insurance companies in the world. I think it's fair to say that Alleghany is firmly right smack in the middle of Buffett's circle of competence. But please don't get discouraged if you don't have 50 years of experience in an industry. You don't necessarily need decades of experience in an industry for it to be within your circle of competence. What you do need is a deep understanding and knowledge in that particular area for it to be within your circle of competence. For example, I own several rental properties in one large city in the Midwest of the United States. I have a deep knowledge of that city. I know what areas are popular, what rents are for different kinds of properties, and a general idea of what a property should sell for in that city. So if someone presented a property for me to buy, I would have a rough idea of what it is worth and if I was getting a good deal. However, if someone offered to sell a property to me that was in Los Angeles, San Francisco, or Seattle, I would have no idea what it's worth. That is because those cities aren't within my circle of competence. Now for Occidental, Buffett's experience investing in oil and gas is not nearly as tenured as it is in insurance, but this isn't Buffett's first investment in the oil and gas industry. Buffett currently holds Chevron in the Berkshire stock portfolio and has previously made billions of dollars investing in the Chinese oil company PetroChina more than a decade ago. Listen to Buffett describe his rationale for the investment in Occidental.
Not great to have an 8% preferred if there isn't any oil. No, it's a bet on oil prices over the long term more than anything else. It's also a bet on the fact that the Permian Basin is what it's cracked up to be and all of that sort of thing. But oil prices will determine whether almost any oil stock is a good investment over time, whether it's Exxon or some wildcat driller. I mean, if oil goes way down, you don't solve that by hardly anything. And if it goes way up, you make a lot of money. And it's not what it does next week or next month or next year. You're buying reserves that go far out into the future. So you have to have a view on oil over time. And Charlie and I have got some views on that, not too specific because they're not that well informed, but they are. We feel good about doing the financing.
The next concept from Warren Buffett's investment strategy that is very relevant is the concept of margin of safety. Remember Buffett's 2 rules for investing? Well, margin of safety helps you avoid losing money when investing. Margin of safety is all about buying $1 for 70 cents. Let me explain what I mean. Let's say that you have a stock you want to invest in. Based on your analysis, you believe the stock is worth $100 per share. However, the stock is currently trading at $70. The difference between what the stock is truly worth, the $100, and what it is currently selling for, $70, represents your margin of safety when investing. Insurance companies like Alleghany are valued based on a metric called price-to-book ratio. Price to book is calculated by taking a company's stock price and dividing it by its book value per share. To put it simply, a company's book value is what would be left over if the company sold everything that it owns and used that money to pay off all of its debts. The money left over would be its book value. So if a stock was trading at $10 per share and its book value per share was $5, that would be a price-to-book ratio of 2. Buffett's offer to buy Alleghany values the company at a price-to-book ratio of 1.26. Just for a reference point, this is significantly below Berkshire Hathaway's price-to-book of around 1.6. At a price-to-book of 1.26, this deal is valued below other insurance companies. Insurer Markel, which is essentially a larger version of Alleghany, currently trades at a price-to-book of around 1.5, and Chubb has a price-to-book of over 2. Keep in mind that Alleghany is unique among mid-sized insurance companies in the fact that it also owns non-insurance businesses that I talked about earlier. Those non-insurance businesses alone generated $175 million in after-tax profits last year. Based on my calculations, the value of the non-insurance businesses is somewhere around $3 billion. If this is the case, then Buffett is paying around just a 1.1 price to book for the insurance side of Alleghany. Alleghany's insurance operations are high quality. Buffett is essentially paying 1.1 times book value to acquire Alleghany's insurance business. Considering the fact that similar insurance operations trade for a price to book in the range of 1.5 to 2, I would make the argument that there is a significant margin of safety in this investment. Remember how in the clip of Buffett, he talked about how the success of any investment in an oil company depends ultimately on the price of oil? One important metric to understand when evaluating oil and gas companies is their break-even oil price. This is the price of oil at which the company would break even in terms of profit. If the price of oil falls below that, the company starts to lose money. If oil prices are above that break-even price, then the company is profitable. Occidental's current break-even price is less than $40 per barrel. This means when oil is above $40 per barrel, the company is profitable. The higher oil prices go, the more money the company can make. Oil prices have recently spiked above $100 a barrel. The difference between the price of oil and the break-even price of Occidental is one way to evaluate the margin of safety of the investment. Buffett buying more shares of Occidental is essentially him saying that he doesn't know exactly what will happen with oil prices, but he believes they will stay firmly above Occidental's break-even price. If prices stay above $100 per barrel, Occidental will be printing money. I hope this video was really helpful for you guys. Make sure to hit the like button and subscribe to the Investor Center because it really helps out the channel. If you're interested in seeing what stocks I own in my personal portfolio, make sure to check out my Patreon at the link in the description because this is where I upload all the spreadsheets and tools I use to analyze stocks. There's a ton of valuable resources on there and I upload new things every month. As always, thanks for watching and I'll talk to you again soon.